Hi, everyone. Thank you for joining today's Office Hours on Professor Siegel's Market Outlook and Insights for Your Portfolio, where you'll hear from Professor Jeremy Siegel, WisdomTree Senior Economist, Andrew Okrongly, Director of Model Portfolios, and Ryan Krystopowicz, Director of Client Solutions.
Well, thank you very much, Irene. On behalf of Andrew and myself, it's really our pleasure to introduce one of the most influential voices in economics and finance. He's been called the Wizard of Wharton, where he's taught for over 45 years. Many of you know him for the author of Stocks for the Long Run, which is considered one of the best investment books of all time, my #1 favorite. And in addition to the academic work, he serves as WisdomTree Senior Economist, as Irene mentioned, helping shape the Siegel-WisdomTree Model Portfolios, which we're going to talk about today, and as well as his outlook. So we're just honored to have him here today, share his insights on the economy, the Fed, and the market outlook. How is that as an intro, Professor?
I love it, Ryan. Great.
This is going to be 45 minutes. The first 30, I'm going to be asking Professor questions along with Andrew. Then we're going to give him a 5-minute break so we can go over the Siegel-WisdomTree models on our website. And then the remaining 10 minutes, it's all going to be devoted to asking the professor the questions that you had submitted. So with that, I want to start with one non-market related question. And we just celebrated 5 years since launching the Siegel-WisdomTree models, but your association with WisdomTree goes back over 2 decades. I'd love to hear that story and what attracted you to WisdomTree.
Yeah, actually, I used to write a column for Kiplinger's magazine, and Kiplinger decided to go completely in-house. And I think within 24 hours, Jono called me up. He had an individual investor magazine, said, Jeremy, would you like to be our columnist? And I said, I'd love to. And I wrote for a column for him. And then finally he called me up and asked me, it was right after the dot-com bust. He said, Jeremy, you think there's a better way than doing market cap weighted investments, maybe weighting by fundamentals such as dividends and earnings? And I said, well, let me do all the research. And I had one of the greatest research assistants, Jeremy Schwartz, who's now, global CIO of WisdomTree. He was my student then, and we went through all the countries and all the rest. We found a better risk-return trade-off going all the way back, all the way back even before World War II, on dividend weighted and particularly earnings weighted type of indexes. And Jono said, he said, Professor Siegel, would you like to join our group? And I had never joined any other group before. Asked a lot of times. I said, listen, I do believe in this, and I'd be happy to be your advisor.
Yeah, no, that's absolutely amazing. And and Jono's our CEO for people that in the audience that are not familiar. But yeah, I mean, Stocks for the Long Run came out. And so today we're going to be really zoomed in on the outlook for the next, say, like 3 months. But I just want to zoom out for a second, right? Because it's so easy to get wrapped up in the moment and lose sight of the long term. You talked about all the data you had going back over 200 years. How are you thinking about stocks in the long run? Any lessons of your book that might be relevant today?
Well, yeah, I mean, the long run real return on stocks after inflation, 6.9% a year, when we updated through January 1st this year. When I did my first edition, which was 30 years ago, 6.7. So we've had a good run, in the last 30 years, even higher than average. My feeling is that we're looking long run. I would be surprised to be 6.9% after inflation. I mean, that's really a very powerful return. I'm not saying it's impossible, but I'm more muted in the direction of 5 to 6% real returns on average. Although if we ever get a turnaround of the value growth trends that we've seen over the last 10 years, our indexes would do actually much better than the market. But it's really very hard to say when that would occur.
Yeah, we'll get into that for a little bit, but let's just get right into the outlook and we'll start with the economy. I saw that you recently wrote about GDP tracking between 2.5% and 3% for the first quarter. Maybe there's an update, but just want to hear about how you think about the economy and what's your high level outlook for it.
Yeah, I mean, obviously tomorrow we're going to get a labor market report, which is important. But I've rarely seen reports. I mean, it's like the data is coming out almost exactly as expectations, very, very close to it, and that expectations of a strong economy. I mean, today we got jobless claims at 220. Now, I've been saying for over a year with a sweet spot for jobless claims is 200 to 240, so we're dead in the middle there. Not too hot, not too cold. I call it Goldilocks on the economy. Of course, we'll get more data tomorrow to confirm that. But right now, I think we're very in a sweet spot where inflation is slowly coming down, but economic growth is exceeding 2% without putting undue strains on the labor market or prices.
Very good. Let's talk about the Fed and rates. I believe you recently used terms like patient to describe the Fed, and you'd said you might get at most 2 rate cuts this year unless economic conditions weaken meaningfully. So is that still the case? And can you elaborate on what
Yeah,
you
we
think
may
of the
not
Fed?
even get two. It has to do with what's called R star. What is that neutral rate? Right now, the Fed says it's 3%. I've been saying for years it's way too low. And actually, for the last 6 months, I've been saying it's 3.5 to 4. Given the strength of the economy recently, I might even say 3.75 to 4. Now, right now, we're at 4.33%. So we're still a little bit in the restricted range, but not very restrictive at all. Despite what Powell said at the last news conference, he thought we were reasonably restricted. That's because he's still using a 3% rate. But if 3% were actually the natural rate, I don't think you would see an economy as strong as we have today. As a result, my feeling is that we'd get 1 or maybe 2 rate cuts or maybe 0 rate cuts this year. We just will, without a recession, if the economy stays this strong, I think the Fed is on hold.
Professor, if I can jump in, just following up, I'm seeing some of the questions that have come in on the interest rate question. If we think further out on the yield curve, you've been talking a lot and writing a lot lately about your expectation for the term premia and
Right.
How effective will bonds be as a portfolio hedge to dampen equity market volatility. What's your latest outlook on that? And I guess a kind of secondary spin on that is, how are you thinking about the movement in long-term rates and as what it might mean for some of the high growth mega cap tech stocks and just, I guess, the stock market in general?
Yeah. Now, I think that bonds are great diversifiers for geopolitical risk. Obviously they're great if we have a recession. They're good diversifiers also. Any of those unexpected type of shocks that affect risky assets. They are very bad diversifiers if we have an inflationary surge. Now, I don't see an inflationary surge coming up. I mean, I think things are going to be pretty quiet on that front. But when you buy a bond, you're buying a 10 or longer term bond. And is there a possibility that we could have an episode not unlike what we had in 2020 to 2022 in the next 10, 15, 20 years? Yes, it is very possible. And for that, those long-term bonds are terrible diversifiers. They'll be hit badly. Now, the normal term premium of long 10-year bonds over the Fed funds rate, and I just reviewed the data on that going back 55 years, is between 100 and 150 basis points. So, if you think the Fed funds rate, we do one cut, we're down to 4, you're talking about 5 to 5.5 on your 10-year bond would be a normal curvature on a term structure of interest rates. As a result, yes, it can be effective as a short-term buffer against geopolitical risks. But right now, I still think the tendency is up. I know it just dropped below 4.5, which actually surprised me. But my feeling is the bias on long rates will be upward over the next 6 to 12 months.
Thanks, Professor. And I guess one other question that it makes sense to address now. It's a lot of people have been asking it. You mentioned inflation, and I know the topic of kind of the lagged impact of housing costs on CPI metrics been something that if anyone's been listening to our office hours, we've all been talking a lot about. The other, I guess, potential theme now that could impact inflation going forward is the risk of tariffs and broader trade disputes. Yeah. What's your take on that right now?
Okay, so let's go through the rental. We're beginning to see signs that the cool down in rental is beginning to get into the CPI. Instead of the sort of 0.4%, 0.5%, we've seen some 0.2%, 0.3s. I expect that to continue. Remember, shelter is 30% of the CPI and over 40% of the core CPI, a little bit lower on the PCE deflator, but nonetheless a very big chunk. I think that will give you downward pressure as those, when I took a look, I just took a look, by the way, at apartment list trend on rental rates, and they are still downward. We still have had like negative rental rate for new apartments over the last 2 years, and it's still it's not a very strong downward, but it is downward. So I think that will continue to filter in to be, now that's a positive towards lowering rate, but the strength of the economy, I mean, the fact that the excitement over AI and the investment on it, people believe the rates of return on investment are so high that they are not deterred by interest rates, which under more normal periods of time would be considered more restrictive. But under current investment plans and optimism, stock markets, as we know, within 1-2% of all-time highs, people, are feeling really good about their asset values, real estate values, at or near all-time high. So people feel flush on the wealth side right now with the promise of AI and investment. They feel that the demand for goods and services is still going to be there. Now, of course, tariffs are a wild card. The market doesn't like them at all. You saw the way it bounced around right 1 for 1 with when he was putting them on and then when he took them off. I don't like the uncertainty. It's only off for a month, and then is there a possibility on or off again? One has to remember that Donald Trump has measured his success of his presidency as by one criteria is how well does the stock market do. So it seems to me that it would be odd for him to really slap on high tariffs, see the stock market tank, and see his popularity, I think, go down as a result. He's not one of these people that want to wait for you'll thank me in 5 years. That's not Donald Trump. He's out of office in 4. So he's he is, I think going to tread extremely carefully on those tariffs, and because the market doesn't like him, and he uses the market as an indicator of his own popularity.
Yeah. Before we go into equities, just speaking about Trump, I mean, do you have any comments on, as you talked about Powell, about a shadow Federal Reserve chair? I mean, is that a risk that you see in the market, or how are you thinking about that?
Powell and Trump are now on the same wavelength. There's no pressure because the economy is doing well, stock market's near its highs. In fact, he over the last week they clarified, saying, "Oh, I wasn't saying that Powell should lower short-term rates. I would like to see long-term rates, which, as you know, Powell does not control." I mean, that has to do with the deficit and how big that's going to be, geopolitical events, expectations of growth, recession, all sorts of stuff that are not under the direct purview of Powell. He said, I would like to see that go down. And yes, I think we'd all like to see that go down, but Powell doesn't have any power over that directly, and neither does Trump, except, of course, if Trump we haven't seen the omnibus budget proposals. I mean, if every one of his tax cut wishes comes to play, I think long-term rates are going to go up faster because I think the bond vigilantes looking at the deficit are not going to like it. There's where Trump is really more important than Powell in many ways in terms of what controls that long-term rate. But right now they're in sync. Could they be out of sync in the future? Of course. I mean, it's possible that there's an event or normal cycle, and the economy starts slipping, and he would want Powell to lower it much faster than Powell's lowering it. I could see that as a possibility if such event occurs. And now again, I don't see it at all, and they're in sync now. But that's certainly a potential of the future. We also, you have to recognize that Powell's position is protected to the middle of next year if he wants to stay. Trump cannot remove him unilaterally. My understanding is only an impeachment process by the Senate can do that, and that ain't going to happen. I think they should be able to get along over the next 18 months. Who he's going to pick then, of course, depends on, what is going to be happening in the economy in the middle of 2026.
Gotcha. So let's switch to stocks. You've called the tech bubble. I mean, you've been very, very well known for your market calls. And a lot of advisors that we speak with have worry on valuations. And so just sticking with the US and first, I mean, how are you thinking about stocks right now?
Well, and this has been said before, but this is really a bifurcated market in the sense that we have the Mag 7, which is almost 1/3 of the S&P 500, selling at, 35 times earnings. And then you have the X, the S&P, 493, selling at 19 times earnings. Now, I actually believe, I've written on this, that the equilibrium PE should be 20. Now, for the whole market, it's over 20 now, but that's because Mag 7 is 30s. The non-Mag 7 is under 20. And, if we ever see a turn in the narrative of AI, and I've talked about this, it's a very powerful narrative that continues to drive these stocks. It got a little blow there a couple weeks ago with DeepSeek. But narratives need many blows before they are, if I use the expression, blown away. It's like a prize fighter in a fight. He gets one blow to the head, but he's still standing and ready to continue. So, we saw that blow, but yet tech is holding up at this point. Now, I wish I could tell all you that, when could that change? It could be a month. It could be 6 months, could be a year, could be more than that. We have never seen a group of stocks like Mag 7. By the way, nothing compares to it in the dot-com boom, because those were all, PE bubbles, mostly not earnings bubbles. We've never seen the size. We've never seen the size of earnings behind them. In the 100 years that we have data on individual stocks, this is a unique time period. And so it's hard to say. But you can see from reactions that when you sell in the 30s, you got to exceed expectations or you're going to be hit. Exceed. When you sell 15 times earning, you don't have to exceed. If you just meet it, you're fine. What history has shown, that a 12 or 13 PE stock that stays there and it doesn't grow, but stays at that level and keeps on churning out an 8.5% return on capital, which is a real return. That's a return that beats the S&P 500 over the last 30 years, which we know how hard it was to do that. And that's a non-growing 12 PE stock. But what we have is, of course, the Mag 7 continuing to grow, at rates like, in the 20s, expected 5-year growth rates in the high teens, and although slowing down, still bringing home the bacon, as I say, and basically meeting them so far. Competition, margins, DeepSeek might be a little crack, but you need more cracks than that, I think, to break this trend.
What about some catalysts too? So besides the break in strength, you've written before about how regulatory reforms and easing financial conditions might be a little bit more favorable or help out the neglected areas of the market, such as value stocks or small cap stocks. Is that kind of what you're seeing?
Yes, I mean, definitely, yes. I think the regulations help the smaller stocks a lot. I think the smaller stocks and the mid-sized stocks and the value stocks have had trouble because there's a realization there will be little or no interest rate cuts. And the interest rate cuts are more important to those stocks. So there's a discouragement on that. But the regulation side, absolutely positive. The use of AI, if it gets cheaper for these firms, for everyone, it might hurt NVIDIA, but it's going to help everybody else, and particularly small and mid-sized firms. We haven't seen massive implementation yet. We've seen cautious implementation. We'll see exactly what comes up in the next few years, but they definitely stand to benefit from the lower regulation and the cheaper AI.
Gotcha. And if we expand beyond just the U.S., international, people have been asking about that a lot. So just not even putting aside the tariffs, because I know you talked about that. Yeah. How are you thinking about international stocks? Maybe any catalysts you're looking at or things like that?
I've long said that when you go to international stocks, you're going into a value world. And just like value has underperformed growth over the last 10 years in the United States, is a similar reason why international has underperformed U.S. Now, not completely. I mean, the international indices are still slightly underperforming, let's say, Russell Value or a couple of these value indices, but not by a lot, because they're value stocks. There's really no tech. There's no Mag 7 really outside of Mag 7, and that they're all U.S. based. I mean, we have Taiwan Semiconductor, I know Novo Nordisk, I mean, there's a couple, but they're really small in capital value in comparison to the multi-trillion size of the mega caps. And as a result, you're going into that world. You have the rest of the world selling at 15, 16 PE, which is a 6 to 7% real return, even if they don't grow, just on that return to capital, a real return. So you don't really, as I say, once you get down into 15 and below, you don't need much growth at all. As long as they don't disappear on you and get worse, they're going to generate returns that are going to be very competitive. But competitive with, they're not going to be competitive with the 20% plus returns that we've seen on the S&P 500 over the last 2 years. Nothing is that, and I think most people realize, that is not something that we call can project, years and years out. I'm calling this year to be much more cautious. I think we're going to have a correction sometime in the year through some disappointment somewhere that will cleanse out some excess and set the stage for maybe a rotation, depending on what actually gets cleansed out, and higher stock prices toward the end of the year. But I don't see a repeat of the 20 to 25% returns that we had in 2023 or 2024.
Yeah, I feel like I graduated college in 2011, and so it was just a great time to be invested. Obviously there was some minor blimps, but just like anecdotally, have you noticed it just feels like the corrections happen faster and then get over quicker? Do you have any comments on that?
Well, we really haven't had, you get these one-day wonders. You all of a sudden stock, what happened with a couple Mondays ago with NVIDIA, you have these breaks, and then everyone says the rotation has started. Well, we've had about 50 head fakes over the last 2 years. Oh, the rotation started. No, I plot the trend line, and it can be volatile, but the trend line is not broken, which means, the thrust and the momentum people and all the rest, they may be playing a high frequency game going in and out, but the trend of growth versus value is still intact at this point. And again, I'd love to be able to know when it might break down. Nobody knows. I know the type of news events, more of deep seek type news events would do it. But if and when they come, nobody knows.
Yeah. Well, the advisors we work with, they know that they're getting, they're helping their clients by having time in the market as opposed to timing the market. So we'll give you a little bit of a breather, Professor Siegel. We really appreciate you answering those questions. We're just going to highlight a little bit of the models that we have, and then we'll come back, and we got 17 questions, it looks like, to ask you. So we'll give you a little bit of a break. But I'm going to share my screen now, and I'm going to bring up our website here, because I think it's extremely important for advisors to understand that if you like what you hear and you're trying to put these concepts of what Professor had talked about and really leveraging his expertise for the benefit of your clients, well, then we have everything very conveniently located here on our website. I simply went to, wisdomtree.com, and then under Portfolio Solutions, you have our model portfolios. There you get our CIO managed portfolios there. And I'm really hoping that everyone here actually has been on this website before, because if you're not familiar, with us, we have extremely long tenure of running model portfolios. We have a lot of proven credibility and industry adoption, having gone through the very rigorous due diligence processes and RFPs of Merrill, UBS, and LPL. And so right now we have our Siegel-WisdomTree models available for over 85,000 advisors nationwide on their platforms that they're currently on, as well as our website. And so with this website here, you can see 34 portfolios. This is managed by Professor Siegel, as well as our Model Portfolio Investment Committee. So beyond just Professor Siegel, we have a whole team of experts with over 150 years of Wall Street and asset management experience that just manage these models and pay attention to it, all day long. They're backed by a global research team of 30 plus professionals, 15 plus PhDs and CFAs. And really the goal of all of these portfolios, I mean, they're definitely strategic in nature, but I would say painting a broad brush, a common theme is that we're trying to provide after fee, after tax alpha, but in a cost-effective way. And the beauty of leveraging these model portfolios is that we're scouring the 4,000 ETFs that exist, 4,000, can't believe it, but exist in our industry. And we're leveraging WisdomTree and non-WisdomTree asset managers, about 15 different ones, to provide these highly cost-effective solutions where you can get active-like returns in a more passive-like manner. And so we're just showcasing right now on our website, we have 3 Siegel-WisdomTree model portfolios. Depending on what platform you're on, you might have a different variation of it. But just to quickly highlight some of the resources we have, where you can go to the fact sheets, get the commentary, get the trade notifications. You can see here we have the high level stats. So very low cost at 25 basis points. That's all in. There's no strategist fees, even despite having different asset managers. And that's that's the same type of success that we've seen in the longevity model, which is our unique spin on a 60-40 overweighting equities, because people are living longer and need more money in retirement. And then we have the moderate model, which is our 60-40 take, but still leveraging the insights of Professor Siegel. So Andrew, I know I went over that quickly, but would love for you to jump in here and, I can stop sharing my screen, or just let me know where you want to take the conversation.
Sure. No, I'll keep it quick and try to just give everybody a quick flavor of what these models that we're showing here, the Siegel-WisdomTree Model Portfolios, are really trying to accomplish. And at the end of the day, it's really bringing to life the decades of research that Professor Siegel and our own CIO Jeremy Schwartz have put together on building portfolios, and not just on the equity side, but total portfolio construction. And as you can see in the kind of highlighted box on Ryan's screen, there's 3 portfolios that make up this family, with a designed to really give you 3 different risk tolerances for various clients' portfolios. A global equity model portfolio, which, as it suggests, is just an all equity, 100% equity stock portfolio. A moderate portfolio, which is a very kind of, as you would expect, traditional 60-40 type breakdown of stocks relative to bonds. And then a longevity model portfolio, which is kind of one of the flagship funds that we launched in collaboration with the professor back in 2019. And this was really built as a rethink to a more traditional 60-40, bringing to life, again, some of the key findings from the professor's research and conclusion from Future for Investors and Stocks for the Long Run, and those seminal works that I know a lot of you have all read and are big fans of. So what are those lessons? I'd say first and foremost, as the Stocks for the Long Run suggests, we wanted to really build a comprehensive investment solution for the long run. And what that means is, making sure that we are thinking about longevity risk and making sure that to the best of our ability, we're building portfolios that reduce the risk of your clients outliving their money. And we think the best way to do that, going back to the professor's comments at the start of the call, are to rely on stocks as that really long-term inflation hedge, their ability through earnings and dividends to outpace the growth of inflation, protect purchasing power, and while it's unquestionable that over short periods of time, stocks might be more volatile than bonds and cash. over the long term, if you kind of rethink what your definition of risk is and think about longevity risk and outliving your money and protecting your purchasing power, stocks really can be a key way to help mitigate that risk, and leaning into stocks. And that is kind of the work that went into the original think behind the longevity model portfolio, which is about a 75-25 breakdown between stocks and bonds. The other, I'd say, key elements, the professor was started the call off talking about taking a fundamental weighting approach to designing ETFs and designing equity portfolios. And I'd say the other key element on the equity side that we're trying to always bring into these portfolios is a focus on fundamentals, and that while they might not always matter in the short run, for the long run, fundamentals do matter. And we look at fundamentals through many different lenses, but I'd break down three key things that we focus on: valuations and prices. So while we own, there's exposure to both, value, core, blend, and growth in these portfolios. Relative to a market cap weighted approach to investing, we're going to be owning, in aggregate, more attractive price to earning multiples than the broader market. At the same time, though, we're focused on quality earnings, profitability metrics like return on equity and return on assets, screening for companies that are able to grow and sustain their earnings and dividends into the future through pricing power and the like. And so quality is another key fundamental that we're looking at when we're selecting both WisdomTree and non-WisdomTree investments for the portfolios. And then lastly is dividends. Obviously a huge focus of stocks for the long run. That if you look into the holdings of these portfolio, which we hope that you'll explore after the call, you will see an emphasis on dividend-paying stocks, dividend-growing stocks. That's really throughout both the U.S. and international side of the portfolio.
Absolutely, that we will. And yes, just come to our website, check them out. You can even search by your platform. If you don't see it there, you'll reach out to us. So, Professor, let's bring you in here as I stop sharing my screen. We have a number of questions, one of them having to do with dollar strength impacting tech earnings. I believe you've spoken about that very recently. Would love for you to just riff on that for a little bit.
Well, clearly, earnings are in dollars. And if a tech company sells 50% or gets 50% of its revenue from abroad, even if it's getting more, the same amount of revenue, it's going to be lower in dollars. That's a headwind. So 41% of revenue on the S&P 500 comes from foreign sales. And I'd imagine for tech, it's even higher. But it's still very high. So a strong dollar is a challenge for the earnings to come in, because you can't raise the price in euros or yen enough to offset that, because there's competitive forces within those countries that have to be considered. So that the strong dollar is good for the consumer, lower price. In fact, a lot of strong dollar has to do with the tariffs, because if we restrict the flow of dollars abroad because of tariffs, and I said last year when Trump was elected, if he goes tariff route, that was going to be a strong dollar. I mean, that's classic economic theory. Nothing surprising. You put tariffs on, you strengthen the dollar, but that makes that a challenge. Outside the tariffs in and of itself, it makes it a challenge in terms of getting those margins. Now, what it helps is the consumer. So a tariff could go on at 10%. If the dollar rises by 5%, the consumer only gets a 5% increase in dollar price, right? So because 5% can be absorbed by the company that's selling because their currency happens to be weaker than the dollar. So what really happens is, a across the board tariff will bring about a rise in the currency that will offset some, but by no means all of that tariff. But it also makes it a challenge in terms of the dollar earnings.
Thanks, Professor. The other question that it looks like several have chimed in on, I guess, going forward is kind of your view on U.S. deficit spending relative to economic growth, and how will the U.S. economic growth be able to outpace that, and kind of what your views on that broader topic are.
Well, now let me talk about what I think is going to be passed on the tax front. I definitely think there's going to be no problem extending the 2017 tax cuts, which were excellent. But Trump wants to layer a lot more on it. Bring back the salt deduction, not tax tip, not tax Social Security, and a couple of other things. That's going to be tougher to do. If he goes slow on that and we don't blow off it, I do not see the deficit as being something that I think is really going to constrain the U.S. economy over the next few years. And I'm all hoping, as we all are, that DOGE does have some impact that basically will help. Actually, my data shows that it's the middle of the 2030s that things really get tight. In addition, the bond vigilantes who are looking at the deficit will warn Trump if he goes too far. In other words, if they see that the Republicans and Trump have put too many tax cuts in without revenue increases, you will see the bond rate yield go up. And that's going to be not good for stocks, and it's going to come back to Trump. And he said, "Oh, okay, the Republicans are going to you can't go that far." So that's the discipline. The discipline will come from the 10-year bond. The 10-year bond is what really ultimately, and its effect on the market, will discipline the size of the tax cuts that Trump will get. There is no problem, though, in extending them. If he just extends them and does minor changes after that, even with the 15% domestic corporate tax credit, I do not see the deficit as being a big factor that would driving interest rates upward in any dangerous way over the next 5 or 6, 7 years.
Speaking of interest rates, we got a question about how impactful the BOJ's interest rate hikes are to the markets. Obviously, what we've seen that carry trade unwind last summer, and just curious your thoughts on that question.
I mean, that's always been there because you always finance with the yen. I'm just wondering, although I know it did have a big effect on that day, but there were other things actually. It wasn't just the unwind of the yen that caused that August or July swoon, I think. It actually had to do with a very bad economic report, the labor market report actually, that caused people to think, oh my God, the Fed is really behind, because remember at that point the Fed had not indicated it was lowering it. So listen, I know Europe is lowering rates slowly, but they've been in positive range. Japan, for the first time in decades, has had some mild inflation, which a lot of people are welcoming. There seems to be a little bit more entrepreneurial activity going on and desire to step back from regulation. And that's increased investment demand, and that actually puts those interest rates higher. So, yes, it might have an effect on the carry trade. But I think what's going on in Japan is finally more favorable for Japanese markets. And you take a look at Topix, it's selling for about 15 times earnings. Nikkei is a little bit higher, but the Topix, which is cap-weighted, is 15, and the S&P is 22, 23. So you got a big difference for an economy that does show some promise, certainly, I think, at the present time.
That's great. And so as we're wrapping up here, I just want the audience to know that there's a lot of different ways you can leverage what Professor Siegel has been saying in his outlook. We have our CIO managed models. That's over 30 different options. No strategist fee, open architecture models are available on our website. With advisors, we also do custom model portfolios where they can partner and collaborate with our team, and we'll create models exclusively for your clients. And then lastly, we have portfolio consultations for those who create models in-house and you really just want like a wellness check on your portfolio. We can absolutely give recommendations on fund and asset allocation. So Irene, if you could pull up the polling question, just so we can, if advisors want to hear from us directly, we'll make sure that we can prioritize you in the follow-up. And then Professor, as the advisors are clicking or answering this question, one more question for you here. It's a short one. If you have to describe the current market in one word, what would it be?
Choppy.
Choppy.
Yeah. We see it choppy with no clear trend. Nothing really forcing it up or down, and partly that is because, as I said at the very onset, we're really getting economic data that is hitting expectations, and with that, there's not anything that I think is thrusting up and down. If we get, if he goes easy on the tariffs, we continue to get good data, and the inflation data really starts coming down, so the Fed could cut, that could definitely spark a big rally, and I would revise upward my expectations for 2025 returns in that case.
And we would be updating the models, because the beauty of choppiness is that we've seen choppy markets for 5 years. We've seen some ups, we've seen some downs, and whether it's 2022 offering downside protection or just overall 150 basis points of outperformance on the 5-year number, we're very happy about how the models have been doing. So thank you everyone for joining. As always, there's never enough time, but I want to thank the professor for joining us, and we look forward to talking to everyone soon. Thank you.
Thank you all.